Welcome to today's Explainer. It's August 21st, 2026, and today we are completely stripping away the market noise. We're taking a top-down, coldly analytical dissection of today's global asset pricing models. If you actually want to understand the structural forces moving your portfolio right now, you can't rely on headlines. You have to look at the raw macroeconomic foundation. So let's get right into the data matrix.
Right out of the gate, we need to talk about this pivotal quote from Treasury Secretary Scott Bessent. He explicitly noted they're trying to bring the market back into equilibrium. This right here, this is the overarching theme of the day: aggressive sovereign debt intervention. The market is currently testing what institutional analysts are calling the Bessent put, which is a direct attempt by the Treasury to artificially cap long-term yields through massive buybacks. But the real question we need to answer is the market actually buying this narrative?
To figure that out, we're going to follow a strict deductive framework. We'll start with the macro sentiment and foundation, then map out the Treasury and currency dynamics. After that, we'll slice into the equity market microstructure, hunt for alpha and sector rotation, filter through the latest institutional insights, and finally, lock in a concrete strategic action plan.
Part 1. Macro Sentiment and Foundation. When we look at the fundamental economic data driving the Fed's current monetary policy paralysis, it is crystal clear that the headline CPI moderation is masking some deep, structural divergences. Just look at Shelter, Series ID QUSR000000 SATH H1. It printed at a mere plus 0.1% month-over-month. It remains historically sticky and is essentially paralyzing the coastal affordability agenda. Meanwhile, used cars and trucks, Series QUSR0000CTA02, have stabilized, sure, but they are still highly vulnerable to any credit tightening. And finally, services inflation, Series QUSR0000SASLE, is stubbornly reflecting the wage pressures that are trickling down from the energy sector.
We have to cross-validate that CPI data with the core PCE, which, by the way, just printed at 3.3% year-over-year and 0.2% month-over-month. Remember, this is the Fed's preferred metric, and it is firmly indicating that inflation is just stuck, stubbornly sitting well above their 2% target. These structural divergences in the data are exactly what's forcing institutional investors to completely rethink their duration exposure.
And honestly, this number brilliantly illustrates the paradox we're living in right now. The Chicago Fed National Financial Conditions Index, or NFCI, currently sits at negative 0.529. A negative number here means historically loose conditions. So think about that. Despite previous rate hikes and incredibly sticky inflation, the actual financial plumbing remains unbelievably accommodative. And that liquidity is aggressively fueling risk assets.
Moving on to Part 2, Treasury and Currency Dynamics.
Looking into the foundational plumbing of global capital, we're witnessing a totally paradoxical market reaction. The Treasury just announced an aggressive buyback expansion, literally doubling to over $4 billion for longer-dated securities. And yet, the 30-year Treasury yield still climbed to 5.273%. What does this tell us? It tells us the Treasury's intervention completely failed to cap the long end of the curve. The bond market is flashing a signal of severe structural debt fatigue. Effectively, it's an outright rejection of the Bessent put.
And because of that, look at the DXY, the US dollar index. It just dropped to a 3-month low of 98.76. You see, when a government tries to control the bond market without actually fixing the underlying fiscal deficit, the currency is what takes the hit. This debasement strategy creates a massive liquidity trickle-down effect. It sends capital fleeing straight into emerging markets and hard assets just to preserve purchasing power.
Part 3. Equity Market Microstructure. Let's peer beneath the headline indices to gauge true institutional risk appetite. Here's our risk proxy validation. The Russell 2000, ticker RUT, closed at 3,018.53, up 0.87% for the day. So small caps are outperforming. Now, validate that with the ICE BOFA U.S. High Yield Option Adjusted Spread, Series BAML-HA0A High YM2. It is incredibly compressed right now at just 2.75%. When high-yield spreads are this tight, while long-term rates are actually rising, it confirms a massive systemic risk-on environment. But make no mistake, this isn't pure fundamental growth. It is heavily driven by gamma squeezes and systemic short covering. To put it bluntly, the market internals are reflecting aggressive risk parity rebalancing. The explosion of 0 days to expiration or 0 DTE options, combined with systematic algorithmic flows, is entirely distorting traditional equity valuations. It forces us as analysts to fundamentally reevaluate concentration risk, especially since systemic short covering is practically the only thing propping up peak corporate margins in the face of rising capital costs.
Part 4. Sector Rotation and Alpha.
So where exactly is the smart institutional capital flowing today? Let's run through the exact GICS sector performance to map out the rotation happening right before our eyes. The undisputed leader today is materials, ticker XLB, surging 2.1% to 53.52. We are also seeing strong defensive posturing in healthcare, XLV, which is up 1.29% to 174.62. Consumer discretionary, XLY, is having a solid day too, up 1.13% to $118. Then you've got financials, XLF, gaining 0.93% to 57.48, followed by consumer staples, XLP, up 0.79% to 85.99. Communication services, XLC, climbed 0.64% to 111.39, while industrials, XLI, notched up a modest 0.26% to 180.24. Technology, XLK, barely budged, up just 0.14% to 183.35. Now for the red, real estate, XLRE, slipped 0.02% to 45.07. Energy, XLE, dropped 0.20% to 63.62, but the absolute laggard, undeniably, utilities, ticker XLU. It suffered a brutal 2.31% sell-off, plummeting down to 42.76. This perfectly illustrates institutions aggressively dumping rate-sensitive sectors while buying up physical materials and defensive growth.
Now, let's look at the commodity and alternative signals. WTI crude series DCOIL WTI Co. is holding remarkably stable at $86.48 a barrel, and that's despite all the current geopolitical tensions. But contrast that stability with gold futures, ticker GCFE. Gold staged a massive, aggressive rally today, up 3.49% to $4,674 an ounce. This divergence is a blazing siren. Institutions are clearly, undeniably hedging against fiat debasement and geopolitical fragmentation, rather than just trading pure inflation expectations.
Furthermore, as strict analysts, we absolutely must look at digital assets here. Bitcoin, ticker BTC/USD, is trading at exactly $77,232.01, posting a daily gain of 5.75%. This asset is no longer fringe, it is actively behaving as a pure independent gauge of sovereign debt anxiety, and right now it stands as a primary beneficiary of the Treasury's liquidity injections into the market.
Part 5. Institutional Insight.
How are the Tier 1 investment banks actually synthesizing this chaotic data? Well, we have to apply a global noise filter. Look at this insight from ArcelorMittal's leadership regarding India's massive manufacturing growth. India's Viksit Bharat boom is basically the prime example of our new macroeconomic paradigm. We are rapidly moving from an era of pure, unadulterated cost efficiency into a highly fractured era where supply chain resilience and physical infrastructure outweigh absolutely everything else.
But here's the catch. The smartest money in the room is deeply divided right now. JP Morgan just hiked their S&P 500 year-end target to 8,000. They are heavily relying on the AI cloud conversion supercycle and upstream growth. But contrast that directly with Morgan Stanley's base target of 7,500. Their model is rooted in a highly defensive posture, completely focused on geopolitical risk, inflation reacceleration, and tight liquidity. It is a literal battle between the AI productivity miracle on one side and the harsh reality of lethal capital costs on the other.
Finally, Part 6, Strategic Action and Verdict.
So as a fund manager, what do you actually do with your portfolio tomorrow morning? Here is the strict binary action plan. Under Scenario A, if the DXY remains suppressed, you must overweight cyclical industrials and physical commodities. The liquidity has to flow somewhere, and it'll go there. But under Scenario B, if the bond market breaks and those 30-year yields breach 5.30%, you must immediately move to underweight U.S. long duration and hedge heavily with gold. You literally have to adjust your duration exposure in real time in response to these Treasury interventions. There's no room for hesitation.
Our final verdict for today's market is constructive but highly nonlinear. The AI growth pillar is undoubtedly strong, but capital costs remain a lethal headwind that you cannot ignore. The single most important data point you must watch tomorrow is Fed Chair Kevin Warsh's signaling at Jackson Hole. Is he going to validate the Treasury's intervention, or is he going to push back aggressively to protect the Fed's inflation mandate? I'm going to leave you with this stark,
final tail risk scenario to ponder. If the bond market fundamentally and completely rejects the Besant put, leading to a total loss of control over the long end of the yield curve, how quickly does the current equity risk premium just completely evaporate? Keep a cold, analytical eye on the data, adjust your allocations ruthlessly, and I'll see you in the next explainer.